Commodities are a diverse bunch, and each commodity often has its own idiosyncratic drivers. But the asset class isn't immune to the actions of central banks, and indeed, all the hawkishness from central banks has created headwinds for commodities this year. But are we at a turning point? We talk all about this with Ole Hansen, Head of Commodity Strategy at Saxo Bank. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you're an investor or just want to learn more about the topic, this podcast is for you. I'm Mobeen, Director, Macroeconomic Research and Tactical Solutions at WisdomTree.
And I'm Nitesh Shah, Head of Commodities and Macroeconomic Research here at WisdomTree.
Before we begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and, in this episode, Saxo Bank, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. So with that, Nitesh, how about we bring Ole Hansen to the discussion and kick off some conversation about commodities?
Well, welcome, Ole. Thanks so much for joining us here today.
Thank you very much, Nitesh and Mobeen. Thank you for the invitation. It's an interesting time, and there's a lot of things happening. So it's most certainly very, very interesting to discuss commodities and what's happening in the wider prospect.
Great. Ole, before we start with some questions about commodities, why don't you tell us a little bit about yourself? How have you come to your position here as head of commodities at Saxo Bank, and how do your unique experiences? How can you leverage off some of your unique experiences here?
Oh gosh, well, as you can probably see from my slightly grayish hair, I've been around for a while. I turned on a financial information screen probably late 80s, where I started in Denmark at one of the big banks, moved to London in late 80s, and stayed there almost there for around 20 years. During that time, it was both on the buy and the sell side. The thread that's gone through my career all the way has been the futures market. I started looking at futures and trading futures back in the late 80s, first in the fixed income and later on in as a multi-asset perspective role when I worked for a hedge fund before I returned to Denmark almost 15 years ago. But I worked on the live exchange in London with the open outcry, with the multicolored jackets, people losing their voice at the end of the day, but also learned how these markets operate and how they impact each other. And it's basically that knowledge that has brought me to where I am today, where for the last, say, 13 years, I've been solely focusing on commodities, basically looking for providing ideas for our clients, keeping our clients abreast with what's happening in the commodity space. And I do that together with a small group of analysts based here, both in Copenhagen, but also in Asia and in Central Europe. So that's how we communicate. And these days, as we do now through electronic media, we are an online investment bank. We have roughly 1 million clients spread around the world. So obviously, we are a facilitator of access to the market, including ETFs, which obviously has become an increasing big part of what we offer and where clients have shown interest in the recent years.
Wow, that's amazing. So, with Saxo Bank being such a large trading platform, I read on your website more than 95 billion of assets under management. I guess you get to see investor trends from a wide lens. Can you tell us a little bit about the big trends you're seeing right now?
Well, the trends has most certainly. First and foremost, I would say in recent years moved somewhat away from FX towards the stock market and in recent years to the commodity market. But increasingly seen now for the past 6 months because of the interest rate increases we're seeing around the world that carry is back, and that's trying to attract some interest back into the currency market. But I think generally what we try to preach and what we are trying to to teach our investors and our traders is basically diversification is key to a successful accumulation of wealth over time, and that's really also where the ETFs comes in. And then if you look at specifically ETFs, obviously talk with WisdomTree today, what we have seen during the past 6 months is actually increasingly interest for ETFs originated in Europe, issued out of Europe. I think part of that probably to do with the change in regulations last year, where the so-called PTP ETFs, especially when it comes to commodities, there's some changed tax regulations, which basically meant that if you are a provider of access to markets outside of the US, it's basically become too tedious. There's a lot of taxation that's involved, and that basically meant that we had to stop offering these US ones. And among those, we have some of the biggest ETFs in the world, but we've seen declining interest in those and increased interest moving towards the European-based ones. And obviously, WisdomTree is a major provider of some of these, and so that's why I know you guys. I follow what your ETFs and use them as some of the benchmark for some of the performances, because as well, one thing is what I also like is that the fact most of your ETFs are that they track some in some shape or form a Bloomberg commodity index, whether it's an individual commodity or whether it's a basket or whether it's a whole commodity sector. So that's why we watch that closely. But generally, commodity interest has picked up. I lived quite a quiet life for, I'll say, 8 years up until recently. It was mostly gold and oil and some of the other major commodities that where the interests were. But my God, that really changed last year with the war in Ukraine, but obviously also the galloping inflation that suddenly attracted a lot of interest into the commodity space. So it's been a very, very interesting and very busy 12 months or 18 months that we've been through, and yeah, since then we've seen a correction in the market. But the question is really what we're seeing increasing now, whether we are starting to see a through in the market, which we just highlighted talked about in our outlook, which we published last week for the third quarter.
Well, yeah, I mean, we're glad to be providing the variety of products and hopefully providing the right types of solutions for people who are caught up in the tax changes in the PTPs. But also, we like to provide that variety, as you say. Commodities are great for inflation hedging. They're great for diversifying a traditional portfolio. So I'm glad that many of the users of your platform are finding use in these. But you mentioned a very interesting thing. You've published your outlooks. I read them for the weekend with great interest, and it's no secret. Commodity markets have had a gloomy couple of few months. Well, most of this year hasn't been great for the commodity markets, as many market players have been focused on the impact of higher interest rates and what that will do to commodity demand. But actually, on the ground, the fundamentals haven't been hurt that much. You haven't seen a big decline in demand for commodities yet. Maybe that's yet to come, but and supply constraints still remain. Do you think that we are nearing peak bearishness, or how far do you think we are away from that?
I think we are getting quite close. We did see quite a decent pickup in prices during June. So far, this this month has started reasonably well as well. And you can basically you can argue with how much the bad news has been priced in. How many days do you need to open your newspaper or your online news service provider to see the same headline and continue to react upon it? And we all know that the market right now is troubled by the slow recovery we're seeing in China. There's even talk about deflation in the short term, but I think that again probably leads to additional stimulus late in the year, which may kickstart or at least support the economy. And then we have the fight against inflation, which is which is weighing on the economic outlook in multiple geographical regions. And that uncertainty is basically, with uncertainty leading to the risk or worries about recession, I think it's part of the reason why we have seen weakness in prices. Because if you are a company or a buyer of physical commodities and you're worried about a recession, well then obviously you're not buying commodities, you're bringing down your inventory, so you're destocking, and and you can destock to the point where obviously you need to start restocking, and the restocking process will really not start to kick off in earnest until we have more clarity on the economic direction or the outlook for the economy that we are currently looking at. It's obviously very difficult to tie the dots right now or square the dots where we have a US yield curve screaming recession. At the same time, you have a robust stock market, and at the same time, you have strength in the economic data. So we're really still looking at well, in theory, the U.S. economy should basically, from one day to another, fall off a cliff in order really to justify these recession calls, which we are starting to somewhat doubt that will actually come to fruition. So with that in mind, perhaps we are close to seeing a low point. Perhaps not in economic growth wise. That may still slow, but at the same time, the market has been preempting and repricing this risk for quite a while now, and that basically means that we potentially could start to see prices rise before we actually get completely out of the woods that we're currently stuck in.
Well,
Wow.
it seems that the last thing that the Fed wants to do is appear to be soft on inflation right now. Even though inflation is coming down, it is still maintaining its very hawkish stance. And of course, that has implications for commodities and your view. But curious to get your thoughts on where you see US inflation, and can the Fed afford to take a break given where things are right now?
Well, I think that it just looks like the markets or traders, they are born optimists. They want to believe in they will be better tomorrow, and that basically means that if the Fed gives any hint of him pausing or taking the foot off the accelerator, then the market will respond quite aggressively in terms of cheering and looking for the rate cuts to start to materialize. We saw that briefly during the banking crisis back in March, how the market was basically suddenly going from pricing rate hikes to more than a 1% rate cut. And that's clearly way too early for the Fed to accept the market changing the focus in that way. So they really have to send perhaps a more hawkish signal than they would like to, but it's simply because the market has to be kept in this belief or in this focus at least for a while longer, while we still try to get the inflation under control. And inflation direction is I think it's really one that divides the waters right now, because I think the general view is that inflation will continue to come down. I think at the same time we're a little bit more reluctant to believe that the Fed with inflation eventually will come back down to the Fed's long-term target in the 2.5% area, simply because the world has changed quite significantly during the last 2 years. We have a fragmented world. We have geopolitical risks on the rise. We have reshoring and friendshoring of production. All of that is not done because it's cheaper. It's done because from a safety, from a security perspective. These are all adding to some of the underlying of the stickiness in inflation. We have interest rates going up. That basically means the mortgage costs are going up. Renting is going up as well. And then you have and everything is going up. Then you want to be paid a higher salary. And even though the market is looking for the unemployment to rise in order to see weakness in the economy, we also have to remember that we are approaching the big boomer generation from the 60s and 50s. They are starting to retire now, and that basically means even though you have people getting unemployed, then you also have a big amount of people increasingly leaving the workplace. And that basically means that some of the tightness and bottlenecks we've seen in the labor market is unlikely to disappear anytime soon, and perhaps even getting worse in the coming years, especially across the Western world, where we are getting into a situation like Japan now has been in for the last 10 to 15 years.
And one commodity that is most relevant to the inflation discussion. Of course, when we talk about inflation, we talk about commodities in general, but we talk about gold in particular. And many people have been wondering why, when inflation has been going through the roof, why gold hasn't been doing the same. So curious to get your thoughts. I know Nitesh has thoughts on gold, so I'm very keen to get his reaction on your thoughts on this topic as well. But curious to get your thoughts on where you see gold going, say, for the rest of the year.
Well, first of all, it's absolutely right that last year was a bit of a head scratcher. If you are not completely familiar with the what other factors tend to drive gold. True, we had the highest level of inflation, raising higher, the highest level in 4 decades. You need to be my age really to remember what high inflation meant to the economy, and gold didn't really do much. But I think on a year where we had, but generally last year I think gold did extremely well. It ended the year unchanged in dollar terms. It ended higher in other currencies. And this was basically a year where we had a strong move up in the dollar, which is gold negative, and we had this massive surge in real yields, which is also a major drag on the gold price. And actually, at one point last year, and probably even still, we had quite a few calls for sharply lower gold price because real yields were going up to the point that it almost signaled that gold should be trading $200 to $300 lower. The fact we didn't go lower, and the fact we didn't end lower in the year, I think can also be is another, I think, longer term supporting factor. That is central bank demand. Central bank demand for gold last year hit a record high. There's a lot of talk about creating an alternative currency to the dollar. I don't really think it's going to fly, but if it did, it would probably be backed by gold like we saw in the old days, and this part of this de-dollarization that we're seeing, that some of the central banks that are accumulating gold these days, these are central banks where they like to reduce their exposure in dollars, and that trend I think is likely to continue. So I think that's probably the $200 to $300 last year that gold didn't fall based on where it should have fallen. When we look at where real yields went, I think a large part of that was really driven by the fact that there was a flow into the market from central banks just hoovering up physical gold, taking it out of the market and creating a bit of tightness. So that was last year. This year so far has been a bit of a walk to nowhere. We're in a downtrend right now, showing some signs of fresh demand coming in. But generally, the market, gold market, hates uncertainty regarding the direction of interest rates, and that probably will continue to drive the market in the short term. What I do find, and that maybe that's where we differ slightly, is on the inflation outlook. Because if our belief that inflation eventually will end at a higher, settle at a higher level than where the market is pricing it in, just take a look at 2, 5, and 10 years inflation swaps. These are tradable prices or products that can be traded in between banks from bank to bank. And these inflation swaps are basically swapping hands right now around 2.5% all the way out to 10 years. Let's just say, for argument, that it's not 2.5, but perhaps 3 or 3.5%. If that starts to take hold, that belief, that obviously will lead to a major realignment of these real yields. Real yields will come down again, and that could be the trigger for higher gold prices. I think that, combined with the fact that the Fed probably eventually will take the foot off the hiking pedal, and we basically get into a so-called peak rate situation. We have seen that on 3 previous occasions in the past 22 years, that the peak rates in the US signaled a strong move up in gold in the months and quarters that followed. So based on these, my short to medium forecast is still one where I see gold make a new record high. We have a very, very heavily indebted world, which is not with us. I would say would be on balance would be helpful for gold just to have an alternative investment to so-called fiat money. So basically these are our 2 main or 3 main reasons. So real yields eventually coming down again, and inflation settling at a higher level than where the market is currently pricing it.
Wow, it's amazing how our views are so similar in many ways. So we also expect gold heading to a new nominal high. Getting to a real high, obviously, is going to be difficult because it was last reached in the 1980s, and obviously with all the inflation we've had since then, it's going to be a tall order to get back there. But we have our models for gold, and the gold prices are dependent on many things you mentioned: inflation, the dollar exchange rate, treasury yields. We put them in nominal terms because we've got inflation also in the model, so you get a proxy for reals at the same time, and then you've got a sentiment factor within the model, which is based on futures market positioning. And based on just taking a consensus view on the economic variables, we get to that gold price at all-time high. Now, I guess consensus has that kind of view that the Fed will tip, that we'll get a nice pivot, as early as this year, and we start getting decreases in rates. I guess your view on sticky inflation is the sort of counterbalance. That's what probably keeps gold prices that little bit higher. We at WisdomTree think that inflation actually may, in the US at least, may have actually already be slowing down a lot more than what the Fed is currently interpreting, because shelter costs are a little lower when you use more real time measurements. But I guess our view is still that gold will do well, because if at any point the Fed does realize how soft inflation is, they're probably likely to move. But I guess if they take the counter view, that inflation is going to be sticky and higher for longer, um, just curious to think, what is your view on that? Would the Fed be more adaptive in its kind of monetary policy and allow for that higher inflation?
Well, that is the $1 million question, and that's obviously the one that the market doubts right now. That the fact that the Fed could suddenly spring a surprise saying that they're raising their long-term inflation targets. So that is obviously a tall order. So based on consensus, that is obviously a non-consensual view, but also I think one that we have to take into consideration, because we know what will happen if we're still looking at if we stick with consensus. That will not create really a big stir in the market. But if suddenly we should see a change, that's obviously when we suddenly volatility in the market could spike, and we need to see major realignments across markets. So that's why I think we need just to keep it in mind as a potential outlier of something that could happen. At the same time, Nitesh, when we say, well, if the belief is inflation will come down, perhaps continue at the current trend, well, then again, that will also mean the Fed can take the foot off the brake sooner than expected. And again, that's when we hit the peak rate scenario. So you can almost have a have a bullish argument in both cases. So which is obviously a bit. Which is that nothing is ever for sure in this world, for certainly not the commodities. I think especially when you look at something like gold, it really is a market where I quite often come across people saying, well, they it's either all in or all out, because it's one of these markets where you almost need to fall out of love with it before you can fall in love with it again. There's not really any middle ground. So quite often people get very frustrated that it's not behaving like a rocket, just going in one direction for months. It just simply doesn't happen, because it's part of it is a currency, and that basically means it's operating in the world of other currencies, and what happens elsewhere does have an impact on gold. So it's just one of these things that you almost, when you get most despair, that's quite often the time where you should think the opposite.
Thank you so much for that, and I do agree. I think people have these perceptions of what the asset class should do, and they either falling in love with it or hating it, but there is very little middle ground. I do agree. I don't know
Yeah,
if we can
absolutely.
move a little bit to other parts of your outlook. You touched on China, and I was wondering if you could expand on some of your views there. They haven't come up with the big bazooka yet, but do you think they will? And what if they do?
Well, I think they almost have to, because I'm not quite sure whether they can live with growth at these lower levels. Obviously, they are indicating already now that they won't. They're taking a focus away from growth to more sustainable growth, and perhaps focusing on areas that may not create the same amount of growth that it did in the past. So it is a we are a little bit stuck here, but I think overall that I would be surprised if we didn't see additional measures and initiatives being taken, at least just to stabilize the economy, because the data that comes out are clearly not great. We have a very over leveraged economy, a lot of debt that needs to be brought down. So that's how the man in the street thinks right now. So it is a troubled. It is a current challenged outlook. But we see that potentially change into the second half. But at the same time as well, I think you mentioned at the start. One thing is we have grown accustomed to Chinese demand. I started working for a hedge fund in '99, and we were very heavily involved in commodities. And you can obviously imagine what happened to returns over the following 10 years when China joined the world and basically gulped up everything that looked like a raw material. So it was a golden decade for commodity trading, and then we went into a bit of hibernation. But that demand was the key driver for prices back then. But I think looking ahead, an equal focus should be the supply side as well, and that basically also makes me believe that we are close to a through in the commodity sector, because we will be facing some challenges in the coming years regarding supply of some of these key commodities. The oil market right now is a classical example. Well, yes, right now it's under pressure because every time OPEC cuts production, spare capacity goes up. That creates a buffer, which makes the upside risks lower. That means the potential peak in a rally it's lower than where it was in the before. Demand will start to taper off, but at the same time, because of the electrification and the energy transition. But obviously, major oil companies, they know that as well. So why do they want to get involved with an investment that takes 5 years before they can pump oil out of the ground, and then have to make their money back over the following 10 years if we are seeing peak demand within the next 5 to 10? That is really the conundrum that we are facing in the oil market. I think and looking at the metal market, that's probably where we're going to see even more tightness. We saw in recent reports from some of the big major mining or the quarterly statements from the mining companies that they're all kind of facing the same difficulties with I actually got them written down here because there's quite a few of them, but I'll come to them when I can actually find it. But one of them are obviously the environment. Too much water, too little water. The political intervention, lower ore grade, and so on. And these are all higher production costs. These are all adding to the risk that the increased demand we may see for key commodities, especially industrial metals, in the coming years, will be challenged. And for the mining companies really to have the muscle and the strength to continue to dig deeper and wider, that basically means metal price needs to be at a level that where that's economically justified. So I think looking ahead, one thing is demand, and that's a long answer to your question about China. But looking ahead, one thing is demand, which may not be as strong as we've seen in the past, but equally we could see supply being challenged. And then unfortunately we have the whole climate change, so also having impact on volatility in the crop market, which we've seen increased in recent months as well.
Yeah, I mean, I think that's a very interesting point. There's massive amounts of challenges that the miners are undergoing right now, and I think you lay out the ground there perfectly about what some of the long-term trends are. But Mobeen, I don't know if you want to ask any more questions about the short term.
Yeah, for sure. I think one commodity sector we haven't touched on yet is, of course, agricultural commodities. And agricultural commodities, several of them have been trading in a tight range recently. Some have been doing quite well. But of course, leaning once again off your expertise as a former, with your experience in a hedge fund and your observations on what's going on with Saxo's platform, just curious to get your thoughts on what's going on in the world of agricultural commodities in the short term and maybe going into next year as well.
Well, I think in order to give a solid answer on that, you need to know what happens above the clouds, or if there are any clouds, and that's really what makes this so incredibly volatile. Because agricultural commodities, I would say, are different to some of the others because demand is relatively sticky. Because we know how many people there are in the world, we know what the growth levels are. That basically means we also know what kind of switch there will be, maybe from rice and wheat to meat and so on. And so it's relatively easy to work out what the demand is will be. Where we struggle, that's obviously on the supply side. And the supply side has met and will continue to meet several challenges in the years to come. weather aside, we obviously had the war in Ukraine, which left the supply of wheat uncertainty, increased the wheat supply uncertainty quite elevated for a period of time. That could easily come back. We have Nino and La Nina weather formations, which are alternating between cold and hot, which now it looks like it's turning towards El Nino, which is the hot variety, and that could potentially create some problems in the months ahead. So it's really it's also a tricky market when it comes to obviously you want to speculate in higher food prices and lower food price and vice versa. But what we have seen you talked about the speculative side. If I look at how the hedge funds have been behaving in this market, they have been absolutely they've been taken out the back and been given good holding over, because they've really been struggling just like everyone else to catch up with the speed with which we've seen some of these markets gyrate in recent months. Just take a look at the grain market. With the last couple of months, we've gone from almost several year lows, and suddenly we just surged massively higher due to crop conditions concerns in the US and elsewhere as well. And then suddenly there was a report from the US raising the acreage for corn, lowering the acreage for soybeans, and suddenly you had the biggest dislocation between those two contracts in living memory as well. So it is just a very, very volatile area. But if I should look at it over time, I think unfortunately there's only one way, and that's higher prices. But obviously, hopefully at a pace where it's not outperforming inflation too much.
Wow, that's some amazing insights into agriculture. It is truly one of the most volatile areas, but obviously, if you look year to date, I guess that's probably the source of most of the gains in the commodity market. So it's a very important area. I just wondered if we can just go back to your point you made on oil, because I thought you said something very interesting there. OPEC is intervening in this market, and I guess the headroom for upside after I guess OPEC interventions are always getting a little bit more constrained there afterwards. But what do you think will allow oil to break out of its current range? Is there something particular you're looking out for that could be a nice trigger point?
I think if we look at there's been a lot of, returning to the talk about speculators. We know there's particularly one guy in the Middle East who really don't like speculators. And he's actually a very critical guy when it comes to decisions made in the oil market. It's the Saudi energy minister. He's been out railing against the speculators on a regular basis. The problem is when you are speculating and railing against the speculators, you're actually also railing against the FOMC. Because right now we're having a battle, I would say, almost between the FOMC and OPEC, because FOMC is looking to kill growth, and if you are a macroeconomic based fund, you are looking for hedges to hedge against a slowdown in growth through the mechanism that comes through higher rates from the FOMC, and then you look at oil market as a potential hedge against an economic slowdown. So you're selling oil not because you don't like, not because you for any other ulterior motives, but simply because you're looking for a hedge against an economic slowdown. So basically, what should change? What needs to change? Well, that basically will be that the market gets a firmer grip on the economic outlook and where we're heading. That perhaps we can avoid a recession in the U.S. That recession elsewhere will become lighter than otherwise feared. I think that really is the main trigger point, because that would remove the short selling in the market, or at least bring that back to more normal levels, and that itself could trigger a move higher in the market. So I think that's really where it has to come from. And then at the same time, then OPEC will also be OPEC wants to be the central bank of oil. I can understand that they control OPEC Plus, that is. They can control 40+% of the global production. So obviously, you want to have a say and how the market is pricing your biggest assets in most of these countries, and they're doing that by actively managing supply and demand. The only problem is it's easy to pull barrels from the market through cutting production, like we saw Saudi Arabia did unilaterally at the start of this month into August as well, and the combined cut we saw back in April. But what do you do when you want to add the barrels back in again? What do you do with the guy who did not lower the production and instead took some market share away from you? How do you sort all that out in the future situation? Well, it's not really a problem. Is if demand comes roaring back and there's that any barrel you can produce is in demand. But what if the recovery is not going to be as strong as potentially expected, and also forecast, I would say, both by OPEC and the IEA during the current quarter? If we don't see that pick up in demand, then obviously there could potentially be some issues. And also, as I mentioned earlier, the biggest thing the market fear the most is supply disruptions. What if there's not enough oil around? We saw that briefly during the Russian invasion of Ukraine, and but what can mitigate supply worries? Spare capacity. And every time that OPEC cuts production right now, there's not obviously that production can be brought back on at any given time. And that basically means right now we are approaching an OPEC across OPEC spare capacity in the region of 6 million barrels of a spare capacity that can be added back into the market. This is into a market where we are looking for demand this year probably rise maybe 2 million barrels, maybe a little bit less than that, and in the coming years probably less than that. That basically means there's plenty of oil to go around on that account. Obviously, you need to take into account as well that every year you need to find an additional 5 to 10% new barrels just to offset expiring wells and so on. So it's not a one for one, but generally a high capacity lowers the risk of a spike in the future, and that also lowers the potential high in the market. So oil price, I think at this point, I think I'm constructive. I have to be on my assumption that China will do additional measures. US potentially avoid a recession. Then I could see oil prices return to the 80s during this current quarter. Probably not much higher than that, but I think even if we can get to the mid 80s, that's probably pretty. That's the level I think Saudi Arabia even would be satisfied with, as long as they can add the million barrels back, because obviously that's a lot of revenues that they are losing out on during this period of time here.
Wow, that's an excellent, thorough review of what's in store for OPEC over the next few years, because I think it is as you say, it's not just the economics of commodity markets. We have to think about the politics of commodity markets many times. So really appreciate sharing your thoughts with us on that. Thank you so much, Ole, for being a guest on our on the Commodity Exchange. Really appreciate your wisdom and your insights.
Thank you very much, Nitesh. Thank you very much, Mobeen.
But before we let you go, for the listeners and viewers of this episode, if they want to hear more from you, do you want to share any of your social media links, or where can they find you?
Well, thank you for that. Well, first and foremost, obviously, as was mentioned, I work at Saxo Bank. We have a website which is called analysis.saxo. That's where we put out everything we do, from fixed income, currencies to stocks and commodities, and also technical analysis. And I have a Twitter account which is Ole_S_Hansen. That's with an E. I know you guys like the O, but it's actually an E. And that's where I primarily post about commodities. Not many pictures of cats and dogs. So this really commodities at my main focus. So if you want to follow me there, of course you are more than welcome. I'll be happy to invite you into my little Twitter family.
Excellent. Thank you very much, Ole, and thanks everyone for tuning in. We hope you've enjoyed this episode of the Commodity Exchange. If you want to hear more from us, please do subscribe on whichever platform you're using, and please take a moment to leave a rating. You can follow us on Twitter at NiteshWT and at MobeenTahirWT. And if you want to learn more about commodities, visit WisdomTree's website, where we have a wide range of research materials and insights. See you next time.